This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy. Hello, you sexy sat stackers, and welcome to the latest episode of the Bitcoin Bulletin Podcast. As usual, I am Chris, and today is Wednesday, February 14th, 2024. That means two things. It means it is Valentine's Day or Singles Appreciation Day, depending on your point of view. And it also means that today is DCA Wednesday. So we're going to grow that Bitcoin stack a little bit later on in the podcast. But before that, I just wanted to mention that there's a few things I want to talk about today. First of all, inflation just won't go away. But despite that, Bitcoin is pumping as the ETFs soak up more than 10 times the daily supply of freshly mined Bitcoin. And that as we are now less than 10,000 blocks away from the halving. Of course, here on the Space Coast, rockets are launching, rockets are landing with their accompanying sonic ba-booms. And CSW continues to get absolutely humiliated in a court across the pond. I'd have to say, all in all, it's been a glorious day. But before we get into all that and more, let's take a real quick look at the vital statistics. As I mentioned, today is Wednesday, February 14th, Valentine's Day. I was going to say Happy Singles Appreciation Day, but it sure seems like we're getting a pleb baby boom. A lot of you plebs are finding the love of your life, getting married, starting families. At least that's the way it appears on Bitcoin Twitter. Of course, those of us that are a little bit older are way ahead of you on that ball game, but it doesn't seem like, the meme is when girlfriend, oftentimes on Bitcoin Twitter, on Reddit, but it looks like a lot of you have found your girlfriends already based on the number of baby pictures. I see Katie the Russian was posting her ultrasounds the other day, and I forget who else was. Was it Roman Martinez, Chimbera? Anyway, a lot of you out there are growing big, happy Bitcoin families, so congratulations to those of you, and happy Valentine's Day to you and your significant other, regardless of where you may be. Back to the vital statistics, though. At the time of this recording, we are at block number 830,508, and Bitcoin is ringing in at a stunning $52,210 per Bitcoin, or a paltry 1,915 sats per dollar, depending on how you look at it. That is sad. Last week, we got 2,248 sats per dollar when we converted our US fiat into Satoshis. So we're going to be getting more than 300 fewer sats just because price goes up, number go up and to the right. And that, that's one of those things that was bound to happen. As the price of Bitcoin goes up, the number of sats per dollar, obviously you get decreases. So hopefully you've been stacking alongside us for this last 2.5 years or even longer, because while we never want to keep stacking, it is looking like it's going to get harder and harder to grab a stack in appreciable size of Satoshis. Certainly a lot harder to become a whole coiner unless you have a spare $52,210 laying around. I know that's not the case for a lot of you listening to this podcast. It's certainly not the case for me. So hopefully you are already either there or well on your way. As I mentioned, we have less than 10,000 blocks to go until the next Bitcoin miner award halving, 9,492 blocks to be precise. Obviously, that's a big deal. Every 210,000 blocks, the reward that miners get for finding the next Bitcoin block gets cut in half. The next time that occurs is at block 840,000. That's looking like that's going to be on April 19th of this year. So we're talking, just barely 2 months away now. We're already February 14th. So we got March 14th, April 14th. And by then, if hash rate keeps going up, who knows? Maybe the halving will be occurring even closer to the 14th than the 19th, because it certainly slid a few days forward recently. I'm looking back a couple of months back when it was estimated that the halving was going to occur on April 22nd. So then it moved up to the 21st. Then it was at 420 for a while, which is kind of Elon Musk's favorite meme number. And then the last 2 weeks, we've been looking at April 19th. But blocks keep coming in under that 10-minute average. I'm getting ahead of myself. But the reason I'm talking about this now instead of when I normally would be talking about it in the vital statistics is because just the other day I saw someone on Reddit asking, is the halving always 4 years? Or could the time slide depending on hash rate? And you would be surprised at the number of answers that said, not that it's fixed 4 years. Pretty much everyone seemed to know that it's set in block time, that it will occur at block 840,000 regardless when that occurs. But the number of people who said it's going to be exactly 4 years because the difficulty adjustment makes up for it, that it factors in the fact that hash rate is either going up or down and keeps blocks coming in at 10 minutes. So it's going to keep it at 4 years. And I jumped on and pointed out, the halving is going to be a full month earlier this time than it was in 2020. And that is because while the difficulty adjustment is genius, since hash rate usually is up and to the right in the history of Bitcoin, in its entire history, hash rate has been exploding. That every time the difficulty adjustment kicks in to bring block times in line to that 10-minute average, well, additional hash rate comes online. And so we start getting faster than 10 minutes again. And so there's another difficulty adjustment that increases the difficulty to slow down those block times, but then more hash rate gets poured onto the network. And that's why we've seen the estimate slide from April, I guess, as far as April 24th, just a couple of months ago, to now looking at April 19th. And it is possible that hash rate, does decrease, and it does that from time to time. For example, during either the hot summers or the cold winters in Texas, when a lot of the miners shut down to help balance the grid, we have seen hash rate temporarily fall off. In 2020, when we had the China mining ban, we saw like almost a third of hash rate fall off, but within a few months, it was all back on. So just like while Bitcoin price goes up and down, if you zoom out and look at the overall trend, it's consistently up and to the right. Same thing with hash rate, with network hash power securing the network. So to answer your question, if you are out there listening on Reddit, the halving time frame, again, it's not set in human time. It's set at every 210,000 blocks, but those blocks, in general, the halving has progressed where it is slightly earlier than 3 years. I'm sorry, slightly earlier than 4 years because of the increasing hash rate on the network. And that obviously we've seen that play out just in the last couple of weeks, watching the halving date move up to as early as April 19th. Of course, we won't know when that's going to happen until it happens. Even on the day of the halving, it's always possible to get a couple periods where you have 1 or 2 hour block times, because again, this is just an average we're talking about. And I remember last halving in 2020, most of the halving parties, of course, were online because they had the thing going on. You couldn't really travel, let alone travel internationally. So I think Bitcoin Magazine had one of the biggest podcasts, or one of the biggest live streams events where you could, log in and participate or just watch as they counted down towards the halving. I think they're doing that again this year, although I wouldn't count on them being the biggest, because a lot of Bitcoiners, especially maxis, are a little bit less than happy with Bitcoin Magazine for their shenanigans when it comes to the wizards, etc. But we've talked about that plenty, and I'm getting way off track. So let's get back to the vital statistics. And this is a big one. Bitcoin's current price gives it a market capitalization of $1.02 trillion. That is more than $100 billion more than last DCA Wednesday. And above that magic number, that $1 trillion mark that I said, this is the magic number when the traditional financial media is going to sit up and notice. This is when Bitcoin has joined the ranks of the big boys as far as they're concerned. This is a big deal. If Bitcoin stays above that 1.02 trillion or explodes even further in price, maybe we will get a new all-time high before the halving. I doubt it. I wouldn't put my money on it. I know a lot of people are betting on that happening. But again, this isn't a normal halving cycle. As we mentioned, the ETFs are soaking up way more Bitcoin than is being mined by Bitcoin miners. The majority of Bitcoin for sale on exchanges is the result of commercial mining operations selling some of their Bitcoin to pay for their expenses, with all that Bitcoin being soaked up by BlackRock and Fidelity and the other Bitcoin ETFs out there, and additional entities above and beyond that, as we'll get into in the future, or in a little bit in the future being about 2 minutes from now. Things are getting exciting. We're talking Wall Street FOMO and not just pleb FOMO. So, we could get a pullback. We saw that before. It wouldn't be unusual. The previous halvings have all had some sort of big pullback right before the halving date. Traditionally, we cross the halving about 3 to 3.5 times high, 3.5 times higher than the cycle low, which would mean we should be about 45,000 to 48,000 on halving day. But again, Bitcoin's going to do what Bitcoin's going to do, and we won't know what that is until after it's already occurred. So sit back, buckle up. I hope you got enough Satoshi stacked. If not, hopefully you're stacking more alongside us today, because time is running out. And speaking of time running out, For those of you who value your wealth in shiny yellow rocks, it's currently going to cost you 25.7 ounces of gold to purchase just one Bitcoin. That is 3.8 ounces more than just last Wednesday. That is almost a quarter pound of gold more to purchase just one Bitcoin than last week. I keep saying you get Bitcoin at the price you deserve. If you're a gold bug and you're holding on to your gold and not getting off of zero, there's plenty of gold bugs out there like Lawrence Lepard that are also Bitcoin maxis, or at least into Bitcoin. And then, of course, you got the Peter Schiffs of the world who are gold or nothing, at least as far as their public persona and their tweets are concerned. If you're one of those Mr. Grudgemeyers, one of those Peter Schiff type gold bugs who just won't let go of your gold, you're gold only, you get the price of Bitcoin. You get Bitcoin at the price you deserve. Right now, that's 25.7 ounces of gold, but it is going to be, just a matter of time before we're talking pounds of gold per Bitcoin. I have already said multiple times that we're going to see Bitcoin measured in terms of pounds of gold by the end of 2024. We might see that by the summer of 2024 at this rate, because we're already really close to 2 pounds of gold for just one Bitcoin. If we get another 4 ounce increase, all of a sudden we're talking 29 ounces of gold, per one Bitcoin, almost 30 ounces of gold per Bitcoin, which is just 2 ounces shy of the 2 pound mark. And I think once we're talking more than 2.5 pounds of gold, that's when you kind of stop referring to it in terms of ounces and start talking about pounds. But I'm getting ahead of myself once again. For those of you who value your wealth in pizza, one Bitcoin will currently purchase you 2,920 large pepperoni pizzas from Papa John's. That is now more than 8 years of pizza. One large pepperoni pizza a day for more than 8 years. Between last Wednesday and this Wednesday, your Bitcoin will now purchase you an additional year's worth of pizza as far as feeding your family once a day, or at least eating once a day. I know, you took exception when I said it'll feed your family once a day, that I hadn't met your family. And of course, a large pepperoni pizza doesn't feed my family either. So you know what I mean? The point being, you can purchase now more than I keep having trouble spitting this out, and this has been 2 years I've been saying the same statistic. I keep saying more than one pizza a day. I guess technically it is more than one pizza a day up into 8 years, or at least one pizza a day for 8 years for just one Bitcoin. I was talking about this the last 2 podcasts in a row, that if you started trying to spend your Bitcoin on pizza right now, as fast as the number of pizzas you can purchase per Bitcoin is going up, it's very likely that you'll never actually spend your last Satoshi on pizza, because, just last Wednesday, you would have gotten 2,487 pizzas per Bitcoin. Now you're getting almost 400, a little more than 400 pizzas, 433 more pizzas per Bitcoin. That's more than an extra year's worth of pizza. And by next Wednesday, who knows what that will be? Easily 8 years from now, we're talking 2 cycles from now. So, if you're a firm believer that Bitcoin will be worth more than $1 million per Bitcoin after 2 more cycles, maybe 10 million, there are people predicting $1 billion Bitcoin, at one point in time. It's conceivable that your Bitcoin will be going up in value in pizza terms faster than you can spend it if all you're spending it on is pizza. And that's really cool to think that if you have just one Bitcoin, if nothing else, at least you can eat one pizza a day every day for a minimum of 4 years. Correction, 8 years at this point. So, there's some security for you. Speaking of Bitcoin, speaking of activity, speaking of on-chain, Clark Moody's teeny weeny mempool, as Marty Bent likes to call it, has currently 91 blocks worth of transactions pending. That's down from the 104 last week, and the 112 the week before that, and the 128 the week before that. So according to his mempool statistics, transaction volume has slowed down a little bit, although that's kind of a contentious statistic because he limits the size of his mempool, and to the default, mind you, which most mempools do, and that a lot of the transactions are low fee transactions, which certain mempools exclude because they're below a certain fee value. So while they're still technically out there in the mempool, the universe that is the mempool of pending transactions, they might not be in your mempool. They're certainly not in Clark Moody's mempool. But we keep discussing his mempool because we have every week for 2.5 years, more than 2.5 years. So even though there's a debate about whether or not his mempool accurately reflects the overall mempool, for the purpose of consistency, we're going to keep looking at that statistic. And speaking of Clark Moody and his mempool, his fee estimator is currently recommending that if you want to guarantee that you do an on-chain Bitcoin transaction and get it included in the next block, it's recommending a fee of just 44 sats per VByte. That is less than half of last week, where he was recommending a fee of 101 sats per VByte. He's recommending that if you have up to a day to wait, a fee of 24 sats per VByte will be mined within a day. The big change, though, is he's finally abandoned that 6 sats per VByte will get mined within a week thing, because I haven't seen a 6 sat per VByte transaction mined at any point in time in the last several months while I've been watching. It's possible one snuck by while I'm not, because I don't watch every single block. But I do look at mempool.space quite frequently, and it shows the fee range, etc., quite clearly in easy to understand, easy to read format. And I haven't seen a 6 sat per VByte transaction mined recently. So currently, Clark Moody's estimating if you have up to a week to wait, that you need to include a fee of 11 sats per VByte, almost double what they had been recommending. Mempool.space, as usual, tells a slightly different story. They're saying that a high priority transaction will be mined in the next block or so for a fee as little as 16 sats per VByte. And even with Bitcoin over $52,000 right now, that's still only a fee of $1.17 US. They are, however, saying that even a medium or low priority transaction should still have a minimum fee of 16 sats per VByte, and a no priority transaction should have a fee of at least 10 sats per VByte. So again, if you're doing on-chain transactions and you have the choice to set your own fees, to choose your own fees, then make sure you have the most recent up-to-date data. I get my data from those two different sources, Clark Moody's dashboard and mempool.space. Mempool.space, I think, tends to be a little more reliable. And of course, make sure you're using a wallet that lets you use replace by fee, so you don't end up with one of those transactions that just get stuck on the mempool forever. All right. That metric that has been my favorite for most of this podcast, Bitcoin's 24-hour average transaction rate, has had a big change. As you remember, before the whole Taproot activation, when we got flooded with ordinals, inscriptions, BRC20 token transactions, etc., it used to be anytime we saw transaction volume above about pi, 3.14 transactions per second, I saw that was an indicator that Bitcoin's price was pumping. At least that's the way it worked out. Not kind of really any official TA, just the way it's worked out during the 2.5 years we've been doing this podcast. That kind of went out the window because we were seeing transaction volumes as high as like 7 transactions per second, with all that miscellaneous data clogging up the blockchain, basically getting 4 megabyte blocks instead of 2 megabyte blocks. And that's my pet peeve with these ordinals inscription shenanigans. Part of SegWit 2x back in the day during the block size wars is we were going to adopt SegWit, and then there was going to be a doubling of the block size, going from 1 megabyte to 2 megabyte blocks. We've effectively doubled the block size again, going from 2 megabyte to 4 megabyte blocks, just by discounting the fees for these ordinals and inscriptions and letting them jam up the header with data, with JPEGs, etc. So I still have a real big problem with that. Whether I think we need to do a hard fork and roll that back, that's debatable. I'm also a big code ossification guy. I think don't mess around and find out when it comes to Bitcoin. What gives Bitcoin its value is the fact that you can rely on it, that it's immutable, that it's uncensorable, and nobody's ever going to change that, not even by accident, by introducing a code change that has an unintended consequence. Boy, have we seen our fair share of unintended consequences with some of these code changes. I'm getting ahead of myself again, but the big change this week is that our current 24-hour transaction rate is averaging just 3.63 transactions per second, down from 5.01 last week and 5.9 the week before, yet the price is pumping. So maybe we're getting beyond, especially as Bitcoin's price goes up, maybe the ordinals and inscriptions thing is settling down, and we're getting back to normal where anything greater than 3.15 or so is indicative of a healthy bull market. I guess that remains to be seen. But currently, with Bitcoin pumping, we're looking at an average 24-hour transaction rate of 3.63 transactions per second, a healthy amount of on-chain activity by the old school rules, slightly anemic compared to what we'd seen with the mempool bloat. And speaking of on-chain, we are just about a day away from the next Bitcoin mining difficulty adjustment. We just spoke about that a little bit earlier. As you know, the difficulty it takes to find the next block is adjusted every 2016 blocks, which again works out to about every 2 weeks, but it's not based on time, just like the halving isn't based on time. It's based on those blocks. We currently have 84 more blocks to go until that difficulty is adjusted. And that's going to be another big increase. Last difficulty increase was an upward adjustment of 7.3%. And depending where you get your data, we're looking at about a 7.7 to 7.77% increase in the difficulty. And that, of course, is to slow blocks down so that it shoots for that average 10-minute block time. And currently, blocks are just screaming in at 9 minutes and 17 seconds. Not quite as fast as last Wednesday when they were coming in at 8 minutes and 55 seconds, which is why instead of as much of a 12% increase, we're looking at a maximum of about 7.8%. And of course, we won't know until tomorrow, but obviously the closer it gets to that time, the more of a valid average we have, and the more assured we can be as to exactly what that difficulty adjustment is going to be. Either way, unless things just go completely haywire, we're looking at another really big difficulty adjustment, and that is because hash rate has just been pouring onto the network. There has been a lot of speculation as to why that is, whether or not some of the new generation ASICs are starting to be rolled out. One of the things that Bitmain is kind of notorious for is even before they roll out their ASICs, they like to test them for as long as 90 days. If you remember during the last bull run when the S19 was coming out and the Antminer S9s were still kind of the state-of-the-art miner, people were complaining because they order these ASICs from Bitmain and they're showing up dirty with dusty fans and dusty circuit boards because Bitcoin had been testing them for several months. So it's a distinct possibility those super go fast new ASICs are being put to the test in Bitmain's warehouses for testing purposes, but nonetheless contributing to the hash rate. Also, there was speculation that additional countries are starting to get into Bitcoin mining. It's speculated that Russia, for example, is getting into Bitcoin mining. We already know certain Middle East countries are starting to get into Bitcoin mining, so maybe that's starting to accelerate. Either way, that's good for Bitcoin, despite the fact it means that it's going to be harder and harder to mine a Bitcoin. That's a good thing when it comes to network security. There's no way you can argue about that. All right, real quick, I want to thank you for listening on your favorite Podcasting 2.0 apps. Podcasting 2.0 apps such as Fountain allow you to earn sats for listening to your favorite podcasts, but they also allow you to help support your favorite podcasts through the value for value model by streaming sats on a per minute basis or by sending a boost, which is a one-time basically tip to the podcast where you can send a shout out, a message to your favorite podcast, but because it's a Lightning transaction, it comes with some sats. And we have 2 shout outs to read. One of them is from 2 episodes ago, and that's because Leggy, longtime supporter of the podcast, squeaked one in right under the wire. In fact, he boosted us for episode 147, which was January 31st, and the boost came in after I was already in the studio recording. And Leggy sent 2,222 sats and said, "OMG, mining going nuts?" ? Last minute boost! ! And boy, it was a last minute boost, and yeah, mining certainly is going nuts. And despite the fact I do a little bit of home mining on the side, which means I'm going to be getting less Satoshis, I'm mining at a loss anyway. So it is what it is. And I kind of like mining even at a loss because it's kind of the ultimate form of dollar cost averaging where, we're going to purchase consistently regardless of price. Mining is definitely stacking consistently regardless of price. If you have a certain amount of hash rate until the next difficulty adjustment, you're going to get a specific number of sats per day. And it doesn't matter what the price of Bitcoin is. So thank you for that boost, Leggy. Leggy also sent a second boost a few days later, and this is to boost the last episode 148, which was last Wednesday, February 7th, for DCA Stack 133. And Leggy took a little bit of exception with what I said about Bitcoin mining and demand response, boosting us 2,222 sats, saying, "I don't think there is an agreement from the miners to turn off their rigs when power is needed. They simply trade their power on the energy market, and when prices rise, it is more lucrative to sell the power than to mine. Outcome is the same. BTC fixes the incentives." And technically, you're right, Leggy, but technically, so am I. It's one of those things. This might just be a semantic thing where I guess it depends on what the definition of agreement is. Of course, different miners in different places of the world have different agreements, different power contracts. They get their power in different ways. For example, there are a couple of places in the United States where the Bitcoin miners are attached to either a coal generating station, or there's even one attached to a nuclear generating station. And so they get cheap, abundant power. Obviously for them, when power is expensive during a time of high demand, it becomes less profitable to mine Bitcoin. And so of course, that's just a market incentive to turn off the Bitcoin. However, There are specific places in the United States, like Texas, for example, where miners do in fact have written agreements with the grid to turn off their rigs in certain circumstances. ERCOT is the big mining grid administrator in the state of Texas, and they have what's called the Demand Response Program. You can find out all about it at www.ercot.com/services/program/load. And basically, they have 3 types of demand response. And on their website, they say demand response provides the ERCOT market with valuable reliability and economic services by helping to preserve system reliability, enhancing competition, mitigating price spikes, and encouraging the demand side of the market to respond better to wholesale price signals. And they go on to list 3 types of demand response. There is the voluntary load response. A customer may decide independently to reduce consumption from its scheduled or anticipated level in response to price signals or high demand on the ERCOT system. This is what Leggy was talking about, where the market decides whether it's worth them or not. This is known as voluntary load response. However, and I'm adding here, even participating in voluntary load response is still subject to an agreement, still subject to a contract. If you are in Texas and you're a commercial miner, I think even if you're an individual mining for your home, you still have to contract with ERCOT to purchase your power, because Texas does things a little bit differently, where you can get your power from a variety of providers, etc. Not providers. ERCOT is going to be your administrator, but I'm a little bit over my skis here because I don't live in Texas, and I don't actually have anything concrete in front of my head, but I have friends in Texas. I've driven through Texas numerous times. But the point being, if you're a commercial company, if you're a Bitcoin miner, you have a retail contract. So technically, a contract is an agreement. I'm not trying to split hairs here, because Leggy's certainly correct, and this doesn't apply to anyone other than those people in Texas in the first place. So, but they go on to say, depending how the retail contract with their load service entity is structured, these customers may have the opportunity to benefit financially during periods when wholesale market prices are high. ERCOT encourages customers to check with their LSE retail electric provider, municipally owned utility, or electric cooperative to find out whether voluntary load response products are available to them. The next type of demand response ERCOT has is emergency response. ERCOT procures emergency response services by selecting qualified loads, like miners, my words, and generators, including aggregations of load and generators, to make themselves available for deployment in an electric grid emergency. ERS decreases the likelihood of system-wide load shedding by paying qualified scheduling entities to make arrangements with residential, commercial, and industrial participants to either reduce consumption or increase generation across the grid when called upon by ERCOT. These participants are required to provide agreed upon amounts of megawatts within 10 to 30 minutes to help prevent or alleviate an actual or anticipated energy alert event. So once again, this is kind of one of those situations where it's kind of semantics, and we have a variety of situations, even in Texas, that the various mining companies can be subject to. For example, we had a couple of different weather events. We had 2 really hot summers and 2 really cold winters in Texas that affected mining. Most recently, the cold front about a month ago. But getting back to the really hot summer last summer, Cointelegraph wrote a couple of articles. The first, entitled "Riot Platform Says Texas Energy Strategy Reduced Production Costs by $31 million." And you remember this was quite controversial, because people got upset that basically ERCOT was paying Riot to not mine, and the people that were anti-Bitcoin were saying that this was fleecing the taxpayer, when in reality it was preserving power for the taxpayer. But I'm getting ahead of myself. The article goes on to say, miner Riot platforms mined fewer Bitcoin in August than July, but received over $31 million in power credits. That is the equivalent of around 1,136 Bitcoin, a CEO Jason Less pointed out in a statement. Riot received an estimated $24.2 million in power curtailment credits under its contract with Texas grid operator Electric Reliability Council of Texas, and $7.4 million from ERCOT's demand response program. So this too is a combination of kind of what Leggy was saying, where part of it was market demand, where they got credits from ERCOT's demand response program, but they also got credits from ERCOT under their contract that they had, where they had agreed to shut down in times of demand. The article continues, according to a presentation released by Riot on September 6th, the company's power strategy is based on 3 mechanisms, and all depend on its long-term ERCOT contract. Power credits are received when the company curtails operations and returns power to ERCOT when the price of electricity makes mining unprofitable. Demand and response credits are received when Riot competitively bids to sell ERCOT the option to control Riot's electrical load, whether or not the electric company calls. I think that's a typo. I think they should have said. I think they didn't mean to say chooses. Whether or not the electric company calls on Riot to reduce consumption. So again, this is two-pronged. Riot apparently has the ability to make this decision on a market basis, and then also ERCOT has the ability to call upon Riot and say you have to do this. Now, they don't mention what the third mechanism is in the article, but according to ERCOT's website, that third mechanism would be the emergency response service. The article also goes on to reference an additional article also by Cointelegraph that's entitled with the headline, Marathon Digital blames weather conditions for mining 21% less Bitcoin in June. The article says, according to a July 5th statement, Marathon Digital experienced a 21% decline in June for the total amount of Bitcoin mined compared with May. The primary reason cited for the declines in production, which saw 979 Bitcoin produced throughout the month, was the impact of the weather conditions in Texas, where Marathon's main operations are located. The article goes on to continue. On February 6th, Cointelegraph reported that crypto mining with firm Riot platform had 17,040 rigs go offline at its operations in Texas due to, quote, severe winter weather in the state. So my words now, this is obviously referencing the cold winter in January. So it's both the heat and the cold where through a variety of mechanisms, whether it be electricity gets more expensive and Riot decides it's cheaper for them or more profitable for them to sell their electricity back, or whether it's through the emergency demand response where they're required to shut down through their agreement with ERCOT. Either way, they turned off 17,040 rigs. Later in the article, they highlight another instance where Bitcoin mining was impacted by severe weather in Texas, saying, this is not the first time that Texas weather has had major impacts on crypto miners. In July 2022, Peter Wall, CEO of crypto mining company Argo Blockchain, which operates a data center in West Texas, told Cointelegraph that the Electric Reliability Council of Texas, that's what ERCOT stands for, sent out a conservation alert forcing Argo, along with many other mining operators in the area, to shut down mining activities temporarily. So this is semantics, and I guess it's one of those things where it depends. I'm not an attorney, but I've taken many law and legal classes, and the stereotypical response, if you're taking a law class and if you're going into law school and you ask your professor a question, the answer is always, it depends. That's the legalese answer. It depends. And in this case, it certainly does depend. So in Texas, which is just one state in the United States, just one place where Bitcoin is mined, miners have a variety of options available to them to turn their miners off, to sell the electricity back to the grid, to not use the electricity they were going to use. Sometimes that's based on market demand, and I guess you could do that whether you got demand response credits or not. But in Texas, they get paid demand response credits if their power contract with ERCOT provides that they're eligible to participate in that program. And then there's also the emergency demand response program where they're just flat out ordered to shut off, and I believe they still get paid for that as well. All right, so hey, Leggy, thank you for both those shout outs. Sorry I didn't get to the one more timely because it was meant to be 2 episodes ago, but I got my podcast recorded a couple hours earlier than normal last week because I had some things going on, and apparently our ships crossed in the night. So I do apologize, but we got that read. Thank you so much for both shout outs. Thank you for the most specific one because both were obviously mining related. The second one forced me to dig in and learn a little bit more, and hopefully provide more information to our listeners, because I was certain that we were kind of saying the same thing anyway, that we were just kind of disagreeing on semantics, but I didn't have the hard facts in front of me, so I did a little bit of research on that, so I could A, know what the heck I'm talking about, and B, help share that information with people who are listening. So there's a little bit of education that we got to other than our normal Bitcoin education, a little bit more education on how Bitcoin is helping balance electrical grids, at least in Texas. And if you learned something listening to that, then thank Leggy, because Leggy's shout out is what prompted that. So Thank you for both boosts, Leggy, and thank you to all of you who listen, regardless of where you're listening, regardless of whether you're listening on Podcasting 2.0 or not. And speaking of our listeners, once again, our geographic distribution of listeners remains exactly the same. Our top 10 countries are as follows. Number 1 remains the United States, so thank you to those of you listening right here in the United States of America. Number 2 remains Argentina, so again, muchos gracias, amigos, in Argentina. Number 3 remains Germany, Dankeschön, mein Freunds in Deutschland. Number 4 remains Luxembourg, Dankeschön, mein Freunds in Luxembourg. Morien, to those of you listening in Luxembourg. Number 5 remains Canada. So thank you to those of you in America's attic. Hopefully the weather is nice up there. It's certainly a lot nicer down here in Florida than when we had that last big winter storm move through. It's not nearly as windy. It's cool out, but it's nice. So us Floridians are probably wearing jackets tonight. But if you're down here visiting from anywhere else in the country, you're probably wearing shorts and a t-shirt. Number 6 remains Spain. Muchas gracias, amigos, in Spain. Number 7 remains Colombia. Muchas gracias, amigos, in Colombia. Number 8 remains Sweden. I'm going to have to take it upon myself to learn how to say thank you to our friends in Sweden. Or you can DM me and let me know if you're listening and you want to help me say it properly. Because, for example, Leggy told me that there's also Luxembourgish, where Morien is a greeting in Luxembourgish, as opposed to just muchas gracias or Dankeschön, mein Freunds, in Luxembourg, which is German. So if you're listening from Sweden and you want to help me out, give me a DM on Twitter at BTC Bulletin Pod, at BTC like Bitcoin Bulletin Pod. And let me know how to say thank you and hello to those of you listening in Sweden. Number 9 remains the United Kingdom. Again, thank you to those of you on the other side of the pond in our cousin England. Number 10 remains Venezuela. Again, muchos gracias, amigos in Venezuela. And thank you to those of you listening, regardless where you're listening, because there's a lot of countries hovering just outside the top 10. It wouldn't take more than 1 or 2 listeners probably to bump your country into the top 10, especially if you're in Mexico, which has consistently been number 11, just a handful of listeners fewer than listening in Venezuela. All right, on to the news. Obviously, the big surprise news on Monday was that inflation came in a little hotter than it was expected. This caused the markets to crash. Even the price of Bitcoin went down a little bit on Monday before bouncing back up above 52,000 today. Bloomberg.com read the headline, "Inflation surprise, transitory gives way to intransigent and maybe overheating. The stubbornness of sticky prices fueled partly by rising wages is what the Fed feared from the outset, and it's happening." Yahoo Finance ran the headline, "Inflation, consumer prices rise 3.1% in January, defying forecasts for a faster slowdown." They go on to say U.S. consumer prices rose more than expected in January, according to the latest data from the Bureau of Labor Statistics released Tuesday morning. The consumer price index rose 0.3% over the previous month and 3.1% over the prior year in January, but slightly higher than December's 0.2% month-over-month increase, but a deceleration from December's 3.4% annual gain. Both measures were higher compared to economists' forecasts of a 0.2% month-over-month increase and a 2.9% annual increase, according to data from Bloomberg. Of course, this is my words now. If you go on to the core basis, where they strip out volatile costs of food and gasoline, etc., inflation was even higher. Don't worry, though. If you have faith in humanity, any faith that is, that humanity is finally waking up to the fact that inflation is caused by reckless or worse, malicious monetary policy, rest assured that is not the case. The average idiot out there still has no clue. TheHill.com ran the headline just 9 hours ago. "Corporate greed increasingly seen as a major cause of inflation," according to a poll. A new poll found that 3 in 5 Americans now say corporate greed is a major cause of inflation. That's a 15% jump to 59% from 44% in January 2022, according to a new poll from Navigator Research. They do go on to say that it's a left-leaning polling and opinion research group. And again, we know that polls can be manipulated, but the government's never going to stop printing our money into oblivion if they are convinced that you're too stupid to realize what they're doing, to see that they're stealing your money, that inflation is the ultimate, most insidious tax, at least as bad, if not worse, than the property tax, although that would be a pretty good tie. But as long as they can print money and cause the value of your dollars to decrease, cause the price of goods to go up in terms of your dollars, your euros, your pesos, and they think you can blame it on greedy corporations, then they're never going to stop. Fortunately, you've already gotten into the life raft. You've already crawled through the escape hatch because we have Bitcoin. Bitcoin will never inflate beyond its 21 million supply cap. So, they can go ahead and shoot themselves in the foot with the US dollar. They can keep letting the average normie believe that, it's Walmart's CEO and McDonald's CEO screwing them out of their money and not their economic policy that's causing so much pain. That is depressing, but I guess it's not unexpected. Despite all the gloomy economic news, obviously Bitcoin is pumping. Even if it isn't pumping, that's not why we're really here. We're here because, Bitcoin is immutable, uncensorable, because it is a hedge against inflation. And in times like now, when there's high inflation, is when you would expect Bitcoin to shine. Maybe not as much until after it's a little more mainstream, but we're going to probably see a lot more of that happen with this halving. And part of that is because the exchange traded funds, the ETFs, are still seeing gigantic inflows that are still outpacing even the outflows from GBTC, with all the people finally fleeing the sinking ship of Grayscale Bitcoin Trust. BitMEX Research has been steadily publishing every day the Bitcoin ETF flow data on their Twitter. On Twitter, they're at BitMEX Research. And they said, all data out for 13 February, very strong day with 631 million positive net flow over all providers. Huge day for BlackRock at 4.93 million. So BlackRock's Bitcoin ETF took in $493 million, which of course they're going to have to purchase Bitcoin with, more than half of the total net inflow. And that is despite the fact that Grayscale still saw $72.8 million outflow. So that's a $631 million net inflow. And they put that in terms of Bitcoin. Basically, the net inflow amongst all the Bitcoin ETFs, even taking into account the 1,469 Bitcoin that flowed out of Grayscale, the total net inflow was 12,735.8 Bitcoin. And that is just today. That's not since ETF launch. That is in one single day. Need I remind you that currently about 900 Bitcoin are mined a day, and the vast majority of Bitcoin for sale is Bitcoin that commercial miners are having to dump to cover their rent, their utilities, their payroll, etc. If only 900 Bitcoin a day are being produced and 12,000 are being soaked up by the ETFs, that is more than 10 times more Bitcoin demand than Bitcoin supply. And that's probably why we're seeing Bitcoin pump, even though we haven't even gotten to the halving yet. Last week, we mentioned Michael Saylor had announced that MicroStrategy had purchased an additional $37.2 billion of the Bitcoin. That is above and beyond what the ETFs are soaking up. This week, it's revealed that billionaire Peter Thiel's venture capital fund had also purchased $100 million of the Bitcoin. In fact, according to Wall Street Journal, Peter Thiel's Founders Fund makes monster bet on Bitcoin. The Founders Fund venture capital firm founded by Peter Thiel has bought large sums of Bitcoin that are now worth hundreds of millions of dollars. The article goes on to say they basically purchased $100 million of the Bitcoin and $100 million worth of Ether. Reuters is reporting the same thing. Executive Peter Thiel's Founders Fund make $200 million in crypto investment before a bull run. So it's not just Michael Saylor and MicroStrategy that's stacking Bitcoin. Now Peter Thiel at least is as well. There may be others out there doing the same thing. But even if they aren't, this is the bull run that's going to prove MicroStrategy's theory, that's going to prove Michael Saylor right. If you remember, MicroStrategy and Michael Saylor started stacking during the last bull run. They did so before the last halving. After the last halving. They have not seen a full cycle. They're already in the green, and we haven't even had our explosive bull run yet. Regardless of what happens to the Bitcoin price in the year after the halving, in general, we can be pretty confident it's going to go up. And all it has to do is even double. If it 10x's or 20x's, God only knows how bad the corporate and billionaire FOMO is going to be. But either way, there's going to be at least one or two wannabe Michael Saylors, wannabe Peter Thiels out there that look at the gains that Michael Saylor and now Peter Thiel are going to make, and they're going to say, I want in on that. Just like other countries are going to look at El Salvador. Again, this is El Salvador's first halving bull run. It's their first halving. So they've already been vindicated, but nothing like they would be if the price of Bitcoin 10x or 20x, and other countries are going to sit up and notice. So this bull run, not only do we have the ETFs introducing normies and their retirement plans, et cetera, their retirement funds to Bitcoin, we're going to have corporate FOMO like you've never seen it before, maybe more nation state FOMO. Things are getting really exciting. On a sad note, if you've been in this space long enough to remember when Bakkt was the savior of Bitcoin. I think it was 2018 when Bakkt which was a company that was founded basically by the owner of the New York Stock Exchange. I believe it's Intercontinental Exchange. They were going to revolutionize Bitcoin. They were going to integrate with Starbucks, where you'd literally be able to buy your coffee on chain with Bitcoin. I think they were going to integrate your frequent flyer miles and your various reward points into Satoshis as well. There was a lot of hope and optimism, a lot of hopium in the Reddit and Bitcoin Twitter spaces about Backed. It never came to be, and now it looks like it never will be, because CoinDesk reported that crypto firm Backed warns it might not be able to remain in business. The company, with backing of the owner of the NYSE, was introduced in 2018 with the initial goal of helping Starbucks customers buy coffee with Bitcoin. Blah, blah, blah. Cointelegraph is reporting similarly. Backed, once touted as Bitcoin savior, is running low on cash. So regardless, Backed never did what it was supposed to do. It had big dreams, big aspirations that never came true. Maybe they were before their time. Maybe they're irrelevant now. You know, they say the difference between wrong and early. There's no difference basically between wrong and early. If you're early, you're still wrong. I'm probably butchering that quote, but the point being, you can have the best idea in the world, but if it's too soon, it's going to fail, even though it was a great idea. And speaking of companies out there that are in the Bitcoin space, the one last thing I wanted to talk about was Strike. That's an app that I use quite often. Sent me an email the other day saying that they're changing their fee structure. Currently, when you purchase Bitcoin on Strike, or when you send cash that they convert into Satoshis, they charge a spread. As of yesterday, I think, as of Tuesday, Monday or Tuesday, they no longer charge a spread, that they charge a flat fee instead, or a tiered fee that it basically starts at 0.99% and then gets cheaper depending on your monthly trading volume. And it's not based on the size of your specific trade. It's based on aggregate, how much you trade during the month. So that's still less than half a Cash App's tier of 2.25%, and Cash App's also charging a spread as well. So this isn't necessarily a bad thing. Basically, they release their fee structure that if you're going to buy less than $250 worth of Bitcoin a month on Strike, you're going to pay a 0.99% fee. If you buy between $250 and $2,000, it's going to be 0.95. $2,000 to $5,000, that drops to 0.89. $5,000 to $50,000 drops to 0.79. $50,000 to $500,000 drops to 0.69, and above $500,000 drops to 0.59. So most of us are going to be in that 0.99% fee range, or 0.95% fee range if you're buying between $250 and $2,000 a month, and that's still cheaper than Cash App's 2.25%. But as I often point out, the one thing I like about Cash App is that they're not going to charge me to transfer my Satoshis to my hardware wallet. So despite the fact I'm paying a little bit more of a fee, I'm going to pay about 45 cents in fees when we stack here in a minute. But I'm not going to pay that $1.17, $1.50 or whatever in mining fees. So it all comes out in the wash. Point being, find an app you like, do your own research, make sure you're comfortable with the fees, make sure you're comfortable with the services they offer. And above all, most importantly, then get your Bitcoin off of the exchanges, because not your keys, not your Bitcoin. All right, there's two other things I wanted to talk about. There's been a lot of talk about a coffee company in El Salvador called Chorrito Cafe. And apparently Chorrito Cafe is doing some pretty innovative things. And I don't know a whole lot more about them other than that. Other than they appear to be backed by a lot of big venture funds. I think Max Kaiser is backing them. I want to remind you, remember we did that episode where we interviewed Gabe from Good Beans? Good Beans is a very small, like 1 or 2 bar stool size coffee shop owned by Gabe. And he has like an employer and a partner, and he's a pleb. And if you want to order your coffee from El Salvador, maybe give Chorrito Cafe a try. But I personally would prefer to support a pleb, to support a small business, to support a business that's not backed by venture capital. So if you are hearing about Bitcoin, El Salvador, Bitcoin, about buying coffee in Bitcoin from El Salvador, about how great the coffee from El Salvador is, check out Good Beans. I think it's thegoodbeans.com is their website. On Twitter, they're at goodbeans. It was fantastic coffee. I've ordered it delivered to the United States. I've paid in Lightning every time it's gotten here within less than a week. It's some of the best coffee I ever had. So if you've never tried coffee from El Salvador, absolutely give it a try. I would encourage you to support a small business and a pleb like the Good Beans. But I don't know much about Chorrito Cafe. So if you do, send me a DM. Let me know what you think about Chorrito Cafe. Again, we're at BTC Bulletin Pod on Twitter. Last but not least, I'm not an expert in the legal proceedings in England, but from what I have read, it looks like fake Toshi CSW is getting absolutely destroyed in court by the Crypto Open Patent Alliance, who's taken him to task over his claims to be the Satoshi Nakamoto, over his threats to bind up Bitcoin development, suing Bitcoin developers, etc. That's been just a lot of fun to see. And BitNorbert on Twitter, and of course HODLoNaut on Twitter, are giving play-by-plays. I do believe today was Craig Wright's last day testifying. The trial is supposed to last about a month because, of course, they have to bring on their witnesses besides Craig Wright, etc. But I have no idea how this is going because I know what it looks like to me. I know what it looks like to all the observers on Twitter, but I really don't know much about the law in England. And I don't know what the burden of proof is for COPA, whether they have to come out and physically deliver the smoking gun saying he's not Craig Wright, period. Here's the absolute proof he is not, or whether it's just enough to cast enough doubt on his claims to say, look, his claims are dubious and get the win. And I don't know the answer to that. So either way, it's definitely making him look like a clown in court. Hopefully it's embarrassing Calvin Ayre and the people that are supporting him in this attack, in this war against Bitcoin developers. All right, on to the reason we are here, and that is because not only is it Valentine's Day or Singles Appreciation Day, it is also DCA Wednesday. For those of you who don't know, DCA is short for dollar cost averaging, and dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals regardless of price. For example, this is going to be our 134th stack. We started stacking all the way back on Wednesday, July 28th, 2021. So far, stacking 133 times. Our equal portion was I chose $20 because I wanted to choose an amount that was small enough that almost anyone listening to this podcast should be able to come up with $20 a week. Of course, our regular interval is weekly on Wednesdays. So far, we've converted $2,660 US, including $59.85 in fees to Cash App, into a stack of 8,904,859 sats, 0.089 Bitcoin for those of you who don't do the sat conversion. And we've done so at an average cost basis of $29,871.33. We're going to add to that stack today using the Cash App, as I've already mentioned. Cash App is not a sponsor of the podcast. They might not even be available where you're listening, but if you are not using Cash App and you would like to do so, there is a referral code in the show notes, and by signing up using that referral code, you'll get $5 free for signing up. That's what the current offer is anyway. That may be subject to change. But if you sign up as of the time of this recording, you'll get $5 for free, and the podcast will receive $5 as well, which I'll immediately convert into Satoshis. Hopefully you'll do the same. So basically you get paid to support the podcast. You'll get something that you wouldn't normally have had. You'll get an extra $5 worth of sats, which is about 6,000 Satoshis at the time of recording. So I've got Cash App open. I already have $20 in there because I was setting some limit orders in case Bitcoin pulled back because, I like to buy the dip. So I'm tapping Bitcoin, tapping buy, entering $20, tapping confirm, and boom, just like that, we purchased another 37,470 sats. That's going to bring our stack up to 8,942,329 sats. So it looks like it's going to be at least one more stack, maybe two, before we break the 9 million sat mark, but we're getting really close. I kind of have an unofficial goal of reaching a stack of at least 10 million sats, but the faster the price of Bitcoin goes up, the harder that's going to be, because obviously we only got 37,000 sats, 30,470 sats for this purchase, as opposed to the 43,000 last week, the 45,000 the week before that, and the 49,000 the week before that. That is the occupational hazard of waiting to purchase your Bitcoin. Obviously, we're doing dollar cost averaging. We're investing as much as we can when we can. That's the whole point of dollar cost averaging. So, I mean, you got to do what you can do. And besides increasing our stack to just shy of 9 million sats, it has also increased our average purchase price. Our average cost basis is now $29,969.82. That's an increase of almost $100. So I think our next stack obviously is going to push us beyond the $30,000 range unless Bitcoin has a big pullback next week. But still, under $30,000 or even right at $30,000 is a heck of a good price considering Bitcoin is worth $52,000, $52,175 at this moment, because that's what we just paid, $52,175, and that's not too shabby. Of course, if Bitcoin just 2x's and makes $100,000 in this bull run, and I don't think that's unrealistic at all, obviously just a 2x would be a very anemic bull run, that stack would have a value of $8,942.32. If Bitcoin 20x's and makes it to $1 million, which would not be unheard of at all, Bitcoin's 20, 30x no problem in previous bull runs, previous halving bull runs. That would be a stack worth $89,423.69. Definitely not too shabby for an investment of $2,680 now, and at just $20 a week. All right, that is all I want to talk about. I need to get this podcast polished up and uploaded before midnight because it certainly is getting close. Before I go, though, I want to ask you to help support the podcast, help feed that algorithm monster by rating or reviewing the podcast, liking or subscribing, or automatically downloading the podcast. Depending on what podcast app you're listening to, you have different ways to help rate the podcast and feed that podcast algorithm monster. Also, you can help expose us. You can help expose more people to us on Twitter by following us on Twitter. And again, at Twitter, we are at BTC Bulletin Pod. And I do want to hear what you have to say about this podcast, what you like or don't like. Thank you, Leggy, for your constant continued support of the podcast through shoutouts, through boosts. That is a heck of a cool way to support the podcast. And let me know what you're thinking to give me feedback. But, plebs, you don't have to do that. You can DM me on Twitter, again, at BTC Bulletin Pod. We're also on Nostr, although not as often as I should. Our NPub is in the show notes. And if you're not on Nostr or Twitter, you can just send me an email. Our email is bitcoinbulletin@protonmail.com. I'd like to hear what you have to say. Either way, though, don't forget to join us next Wednesday where we grow that stack together. And either way, keep on stacking those sats, you sexy sat stackers.